Welcome to The Landscape by George Smith Partners. Welcome to The Landscape podcast. This is George Smith Partners podcast. Today, I'm joined by David Pascal, my co-host.
Hello, everyone.
And of course, I'm Evan Kinney. I'm the CEO of Access Capital, the parent company to George Smith. And if you're not familiar with George Smith Partners, we're a nationwide capital markets advisory firm in the commercial real estate space. And today, David and I are welcoming two very special guests, both of which have very deep development experience in one of the most dynamic markets likely in the world, San Francisco. So, recently San Francisco has been in the news a lot in real estate circles, having experienced and experiencing a dramatic recovery in rents and, mostly driven by the technology industry, AI companies, etc. You do have to be a very tough guy to be a San Francisco developer. Nothing is easy as a developer, and developing in a big city, particularly a big city in California, is a challenge. And both these fine gentlemen today have done that successfully for a long time. So we are very excited to welcome Michael Cohen and Mark MacDonald. Michael and Mark run two different firms, Strata Development for Michael, and for Mark, DM Development. So we'll let Michael and Mark introduce themselves a little bit and their firms, and then David and I will jump into a discussion here today. And thank you guys so much for joining us.
Hello, gentlemen. Happy to be here. My name is Michael Cohen. I'm a principal and founder of Strada Investment Group. We're a San Francisco-based real estate investment and development company. Primarily, we have three business lines, investment strategies. A big part of our business is kind of built to core multifamily, largely mid and high rise, urban center, coastal California. We also do quite a bit of value add core plus investing, primarily that are in multifamily and in office and growing for us in the R&D space. And then partly because of my background, partly sort of in the DNA of our company, we've always had some advisory, large scale, complex development work. And among other things, we were the fee developer for the Golden State Warriors Arena here in San Francisco's waterfront, worked on Pier 70, a number of large, transformative, public-private mainly development.
Great. And Mark?
Good afternoon, Evan. Nice to see you again. Great to be here with David and Michael. My name is Mark MacDonald. I'm the co-founding principal of DM Development. We are a San Francisco-based real estate development firm focused primarily on housing. We have three business lines that we focus on: market rate apartments and for sale condominiums. We also do 100% affordable housing through the LIHTC program. And then lastly, we focus on what we call flexible living, which is a hybrid between hospitality and multifamily, bringing together furnished apartments, flexible lease terms, and all the amenities that you might come to expect in a Class A multifamily building. We have been developing in San Francisco for the last 15 years. We started during the great financial crisis, coming out of a period that is not too dissimilar from the one we're experiencing today. We have built about $500 million of real estate in the Bay Area, expanded down to Southern California, and now we're developing nationally with our first project in Boston.
Great markets. And thank you again, both for joining. I find it interesting. I think both you guys started your firms in 2010, if I'm not mistaken. So, what were you guys thinking in 2010 starting real estate firms?
Well, the first thing was, at least for me, I was leading a very high profile, high powered job working for then Mayor Gavin Newsom, running real estate economic development for the city of San Francisco with a pretty big portfolio. And after 15 years in the public sector, I knew I was done. I wasn't timing the market. It was actually in 2010, Gavin ran for lieutenant governor. I had worked for Willie Brown before that, and he was mayor. I was kind of down. I didn't want to do another mayor. And in retrospect, it was one, terrifying. My co-founders and I, we all had spouses and kids and mortgages, and we're all of a sudden staring down the barrel of no income. But in retrospect, it was the best time to really come into a market that was so rife with opportunity. And in the most old-fashioned adage of real estate, it was a great time to buy good real estate.
Interesting. And Mark, what you also had a very different background to real estate development before you started. So how did you make that transition in 2010?
So I had a career working for a technology company in the Valley, Oracle. I had a 15-year career there and pivoted to brick and mortar from bits and bytes, which was a rather unusual transition in the Valley. But for me, I always enjoyed, creating space, physical environments, places where people could live, work, and play. And for me, creating something tangible, something real was a lot more gratifying. So after a career at Oracle, I went back and got my business degree and started DM development coming out of the MBA program. And like Michael, our first foray after starting DM was to jump right into the fire of the great financial crisis. And while at first it was, as Michael was saying, very scary and terrifying, I think in the end, looking back, we realized it was, in fact, the best time to be starting a business. We didn't have any legacy issues. We had fresh capital that we were bringing to a market where we were buying everything for cents on the dollar. We had no competition, and we were able to lock in construction costs at what were then cyclical lows, and then be able to develop and deliver product into a rapidly rising market where we were literally one of the only ones doing that. And so there's, I think, a lot of similarities between then and now, and having learned all of the lessons, the hard lessons from the great financial crisis, we're trying to take advantage of what we think is going to be, and what is, an incredible opportunity to do development in San Francisco and the Bay Area.
Hey, Michael, let's talk about the Quincy apartment. What year did you build that? At least it had leasing velocity as fast as any San Francisco apartment building in about a decade. What did that tell you about the location and the submarket and what's going on?
Yeah, I mean, it has been remarkable. The Quincy it's a big project. We did it with one of our large domestic pension fund partners, 500 units. We delivered about a year and a half ago in May, and it was interesting. Project that big, we had underwritten absorption of about 25 units a month, and we did 100 units in the first month. And it hadn't really slowed down. I mean, the building is now full on 99%. As full as you can have about a multifamily project. And it's not rocket science. It is a function of the laws of supply and demand, with a slight caveat, which is there historically has been a dearth of what I would consider properly well amenitized, really A+ quality multifamily in San Francisco. Huge percentage of our rental stock, many of which I, in my early days in law school and otherwise, lived in quaint old Victorian, you know, you have the first floor, the second floor. The offering that we have at the Quincy, which has really beautiful amenities, indoor, outdoor spaces. We really think of it with Mark alluded to this, it's almost a hospitality style approach to the property and asset management. We're close to Mission Bay. We're in a part of the city that I think is got great access, not just to the AI sector of the universe, which we have here in San Francisco, but it's easy to get on Caltrain if you're going down to the valley. So I think the location helped, but really the story there is supply and demand. And we delivered that project a year and a half ago, and less than a year and a half ago. And it's probably at least 2 years before another A quality, large scale, institutional multifamily competitive projects going to hit our mark.
Yeah. Well, you know, what's interesting is that you were one of, I believe, just a handful, right, of sort of 2025 deliveries. You know, I think, you know, the ability to capitalize projects in San Francisco really fell off a cliff in March, April, and May, June of 2022, when rates went up 500 basis points. You know, San Francisco being such a tight cap rate market, and of course, cap rates having, you know, some impact, some relation to interest rates directly. You know, Mark and I experienced that working on a project there back in 2022, and you know, we've kind of bemoaned the fact that you didn't deliver into that strong 2025 market. Now, looking at that now, though, halfway through 2026 and kind of moving to the 2027 mark, you know, how do you feel about, I know we have a project we're working on a mile and a half maybe from the Quincy, I think. It's not far, a little different submarket perhaps, but not far at all. You know, let's talk about that. Like, we're going to be looking at a delivery for that project, I guess, when probably beginning of 2029. It'll be 2029.
2029.
Yeah. So let's talk through that a little bit, Mark. Like, how are you feeling about that, and what are you looking at in terms of comps?
Well, you know, I wish that we had started, like you said, Evan, that project in 2022, and we're delivering in 2025. And I congratulate Michael and Strata for moving that project forward in a very difficult time. And I would have loved to have done the same. I think that now moving forward, as Michael said, it's a supply and demand issue here. There are no new market rate apartments under construction now in San Francisco, and there will be nothing delivered for the next 2 years. And so rents are likely going to continue their march upward because demand continues to grow against the backdrop of no new supply. And so we'll have continued rent growth. And I think, you know, a very, very positive market in a couple of years. I think that, you know, what we're trying to do now is start as much as we can while construction costs are still relatively low. They're high if you compare, you know, San Francisco to other cities in the United States and even globally, but where they're going to be, we think that this is a cyclical low because once rents continue their march up and more projects can pencil and become financially viable, you're going to see more construction. And so we do feel like now, even though we would have liked to have started 2 years ago, now is a much better time to start than 12 months or 24 months from now, because even though rents will be higher, there's going to be a lot more competition, we believe, on the construction side.
And I'd love to hear David's back thought on this, but real estate is such an interesting business on the development side because you are at the mercy of so many factors. And Mark, you just touched on a couple of them: costs, labor, you know, your permitting and your entitlement status and the timing on that, your GMP pricing, which factors in all kinds of materials costs that might have global and supply chain and trade implications. And, you know, in order to be a real estate developer, you really have to kind of be able to stare into that abyss and sort of chew on glass and hope that all those things kind of line up exactly at the right time. And what's interesting is that, and I think, Michael, you're kind of touching on this. You know, you had the benefit of getting your deal started must have been in 2023, I would imagine, when you broke ground. So
Yeah.
how did you convince capital at that time when, from my point of view, capital was very, very fickle with respect to development, particularly in San Francisco in 2023? I think a lot has improved both in the macro market, but more specifically, like just the demand drivers of multifamily in San Francisco since 2023. So how did you convince capital in 2023 to do that?
Say this common field, I think who your capital is matters. And we have historically had a couple large programmatic partnerships with domestic pension funds who are long-term investors, and they're not trying to time the market perfectly. They're not facing the pressure of, I've got a fund life that I've got to sell it around. And so I think that fundamentally just helps the equation. And then honestly, it was just unbelievably data driven on our analysis, really on the advanced side. To Mark's point, it was a very favorable market to be buying out a job. That's one. Subcontractor margins, everything you can think of. We had hungry counterparties who were really going to get aggressive and getting us pricing to make the project work. Two, we rely a lot on data. One of my favorite statistics, which we would show at the time, is San Francisco is notoriously considered an unaffordable housing market, which in many respects trying to buy a house in San Francisco remains very difficult. What people don't always realize is our income levels are staggeringly high in the city of San Francisco. And we have a chart that showed the 25 largest U.S. metros in the United States. And if you took average income, you do the typical affordability formula of about a third of your income to pay for rent. San Francisco was like 23rd. New York was the most expensive. We were somewhere between El Paso, I can't remember what the other one. Rents were still reasonably high. We had obviously come through a major dip in COVID and a lot of the COVID-driven disruption, but we were huge believers in the fundamental supply-demand drivers around quality multifamily in San Francisco existed. We also believed that the narrative around the death of San Francisco was wildly overblown. It was very easy to make that case as someone who's lived in the city and county for 37 years. And then the third thing, most of our projects are pretty large, and we are obsessively focused on building efficiency. And so whether it's your operating expenses that you can, in a 500 unit building, particularly if you've got decent geometry to it, you can build efficiently and you can operate efficiently. So it was a combination of, I think, the right product, a good time to be buying out the job, the right capital partner, and then, just being quite dogged in making the case based on the data and looking around the rest of the country, which we knew was being wildly over in Sunbelt markets and
Austin,
the Atlantic coast, and you can think of submarkets all over the United States. And so we were really just honing in on that data. That said, I have learned that a good capital partner is probably one of the most underappreciated elements of the success of our endeavors. And we built up, I think, credibility over time. But it took a courage to go, because they had to go back to their investment committee and say, yeah, we're greenlighting this.
Got it.
Hey, Michael, I would like to bring up some office in San Francisco. You bought 201 Spear in 2024 and One De Hero. Uh, what are your thoughts on San Francisco office with AI, conversions to residential, and what neighborhoods do you like without telling us your secret sauce?
Yeah, I don't know that our secrets are much of a secret.
Okay.
I will tell you again, our office analysis very heavily data driven. Some is looking at, the building that I'm sitting in at Fuel and Spear, which is where we office, which we acquired at $260 a foot, was just such a staggeringly historically low basis that we knew we had some real opportunity. We also saw that there was a lot, similar to what Mark was talking about, right, coming out of the great financial crisis all around us. Uh, Nice building in nice locations. You had operating partners who were underwater. They couldn't write checks for TIs. They wouldn't write checks for TIs. They shouldn't. They were out of the money on the deal. And so the opportunity to be in a quality building, we're close to the Embarcadero. We really, really do love this. I guess the East Cut is the real estate given name for this neighborhood, close to the Transbay Terminal. We really like the neighborhood. We like the building. We love the leases. And I think as a general strategic matter, we don't chase too many true trophy buildings. We like being that A- building right below the trophy building. We think there's some real opportunities to create real estate value in that space. And it's really proven itself true. One to our much higher basis in the land, but again, or in the property, a super, super strong location. That one very directly looking into AI. It has a single tenant who is an AI manufacturing and robotics company. And look, we think there's a lot of differentiation in this market. You alluded to the potential for office to residential conversion. I'm a bit skeptical that we're going to see a lot of that just because of the costs and the challenges inherent in that. But it is true there is a large swath of our office submarket that may be functionally obsolete. There is a massive differentiation for quality buildings and quality locations. There is now quite a bit of demand to the point that we're not doing it yet, but there is going to be new office construction breaking ground in San Francisco, I think, in the next 12 months, which would have been heard of even 18 months.
Very interesting. Very interesting.
Very interesting. I also want to know a little bit, Mark, you have a site right near a bunch of AI companies. How are you thinking about design as it relates to the level of quality, given, I think, what Michael alluded to just maybe 5 minutes ago when he was talking about sort of the demographics and the affordability metrics that they were looking at relative to other markets, despite the chunk rent looking so astronomically high. So number one, how do you think about that? And then how do you juxtapose that, Mark, with some of your LIHTC projects, affordable projects, et cetera, that you're working on? And like, how do you think about the both the...
Yeah, I think what's been really interesting about this cycle, and Michael alluded to it, is the income growth that we have seen. It's really unprecedented in some ways to see what a lot of these tech workers, AI workers are earning, right? 300,000, 400,000, 500,000 plus per year. And that is giving them incredible power to pay rent. And so we're just seeing rent escalation in a way that none of us really anticipated. And so what we're doing now is, whereas maybe in the prior cycle, we were looking at making our units smaller, right? So that we could get the chunk rents down. What we're finding now is the tenants, they just want to pay for the best unit on the highest floor, the most space, best finishes. And so we actually took our project, which was entitled for 168 units, and we reduced the unit count, something that we'd never considered doing in a prior cycle, but we did that. in service of creating larger, more spacious floor plans and more of the larger floor plans. And that was, in response to the demand that we were seeing for bigger units, multi-bedroom units, et cetera. We also, generally at DM, we have a very strong focus on architecture and design. It's part of our brand. It's what we're passionate about. But when our investor came into the deal with us, we were really delighted that they said, push it even further, take the, amenities, take the finishes to an even higher level, which was music to our ears. And so we layered on, additional features, additional design on top of what we had already planned. And so that was unique in that oftentimes when an investor comes in, they say, let's value engineer, let's cut costs.
That's right.
This was quite the opposite, because you do get paid in this market by the technology tenants that have these increasingly high incomes. What's interesting is pre-pandemic, San Francisco saw rent-to-income ratios well in excess of 30%. Now they're in the mid-20s. And it's primarily, even though we've had a lot of rent growth in the near term, we've had so much income growth that it's outpaced the rent growth that we've seen. And in spite of the recent rent growth we've had, we're really only back to close to where we were pre-pandemic. So there's a lot of room to run, we think, on the rental growth side. So we are very bullish on market rate multifamily. We're looking to do more in kind of area AI, as Michael described it. We really like the Mission. We like Potrero Hill, Mission Bay, Soma, Dogpatch, the areas where these AI companies have started to come up and where employees are now living. People are no longer working remotely. They're working in the office again. AI has kind of the unique, I think, attribute as compared with some other technologies where development happens better and faster when people are together as opposed to remotely distributed. And so a lot of founders have been encouraged to start their companies in San Francisco and to live in San Francisco. So that's obviously helped folks like Michael and I who are building housing. In terms of the LIHTC projects, as rents have gone up and as demand has increased, it's made for an incredibly tight market. It's very, very difficult to get an apartment in San Francisco. In Potrero Hill, the occupancy is 98.9%. It's crazy what we're seeing. And so that's for people, who have high incomes, who can compete. For people earning between 30 and 70%, it's become really difficult to find a nice apartment. And so as the boats have risen on the market rate side, they've also risen on the LIHTC and the affordable housing side. So there's an increasing demand for that as well. And so we're thrilled to be building a 425 unit project in the middle of one of the best kind of AI-focused neighborhoods in the city, which is Potrero Hill. And we're targeting that at residents earning between 30% and 70% of AMI, which is about $50,000 to $100,000. So it's not necessarily formerly homeless or permanent supportive housing. These are young workers, service professionals, middle-income earners who want to essentially live close to their office, whether that is a tech company or whether it's UCSF or whether it's a restaurant or if they're a teacher or a firefighter or a policeman. We're able to deliver that. And in talking with the mayor's office, they're incredibly excited about how this project is going to be received and just the demand that is out there and what we'll be able to satisfy with a project of this scale. So we're very excited to continue to do more LIHTC, and we're pursuing a lot more market rate as well.
Just a quick follow-up question to that. And maybe this is, love to hear everyone's thoughts. David, you might have some thoughts on this too, but one of the magic things that San Francisco has kind of going for it, and this was alluded to earlier, not only the technology and AI, but the sort of challenges and difficulty with getting entitlements, getting stuff started, et cetera. It does benefit developers in the long run in some ways because, frankly, there's just not as much supply. So when you guys look at this little window of opportunity today to develop, and you look and you know what's happened in Austin, where during COVID there was a tremendous amount of new supply put on in Austin, and now there's a digestion problem there, right? Like, is there any risk? Well, of course there's some risk, but like, how do you quantify the risk of a lot of product getting started and potential oversupply? Is that even something to worry about, or is the demand so deep right now in San Francisco and going forward, and you guys put your lens on and look out into the future, that we will not have an oversupply issue, just given the challenges with starting projects in San Francisco?
Yeah. I mean, I think in the city of San Francisco, the risk of significant oversupply is quite low. Some of it is geographic. Some of it is, Mark alluded to this, but there are some real cost barriers to, even today with the incredible rates we're seeing, to make projects pencil. I've been doing this a long time. Pendulums swing, and they're not just market pendulums. I believe it is a question of when, not if, that the wonderful, in my opinion, kind of yes in my backyard pro-housing revolution that we have seen in California, that pendulum's going to swing back. I think we're going to see some tightening eventually. I don't know when. But I also think in a city like San Francisco, where you have decades of historic undersupply, and then you got this geographic, we're surrounded by water.
Challenging terrain.
It's a very healthy city, and nobody's knocking down Valley Victorians to build a multifamily project. Literally the number of soft sites that are available to do material new multifamily development in San Francisco are quite limited, and in many cases limited to some of these large scale kind of redevelopment projects like Candlestick and Treasure Island that have their own unique set of infrastructure and other related challenges that make it a little more difficult for them to come to market super quickly. So I worry about it a little more down in the valley, honestly, and we were quite active in the valley, just both as geography. I think there are more opportunities for more overbuilding. But in almost all of coastal California, we are addressing literally probably 40 to 50 years of chronic undersupply.
Wow.
I would agree with everything Michael said. I think that costs are still so prohibitive in San Francisco that despite rents being up 10 or 20% year over year, it's extremely difficult to move projects forward unless you can build for a lot less than prevailing rates. The mayor is helping, I think, with the reduction in inclusionary requirements, the reduction by 2/3 in impact fees. That's marginally helping and making projects more feasible, but still, I believe our city economist, Ted Egan, did a study recently that said there are no projects that are economically viable, market rate projects to construct at prevailing construction costs. So unless you can build for less, it's still very challenging and will continue to be. I think as well, if you look at the historic undersupply in San Francisco, we have been building, like Michael was saying, underbuilding for decades. This is a problem that's been decades in the making. And if you look at the RENA goals for the San Francisco area, we are supposed to build 82,000 units by 2031 to keep up with demand and to satisfy our housing needs. That's 82,000, about 10,000 units a year. Now, if you look at the entire development pipeline in San Francisco now, it's 75,000 units. So even if every single unit of housing in San Francisco was built, which of course there's not going to be anywhere near 75,000 units built, I don't think, then we still would fall short of our RENA targets. And so I am not worried that we're ever going to be in a state like you see a lot of the southwestern cities where we're overbuilding. I think that construction is going to happen. I think as rents continue to march upwards, more projects will become feasible, and this is a good thing. We'll see more housing built, but it will happen and it will come in over time. And so there will be a balancing. I don't think we'll get ahead of our skis, if you will, on building too much at any given time. My sense is we're going to continually be behind playing catch up. And so it's still going to be a good market to be doing development in for the foreseeable future.
Hey, guys, 5 years out, what do you think the San Francisco skyline looks like? And maybe a question for us, what does the capital market look like at that time? And what are you pointing towards to build?
Right. It's interesting. I mean, Mark hit on a lot of this. I think the skyline as we know it, if it's going to change, it's going to change in projects that I spent 15 years of my life on when I was in the mayor's office, which are the next version of Mission Bay and Treasure Island, Pier 70, Candlestick, projects like that. I think we're going to honestly, 5 years from now, going to just seem much more modest. I do think that the mayor's family housing plan, which really for the first time created some upzoning on the north and western portions of San Francisco. I think there's a real opportunity there, but it'll be more we used to call Parisian style zoning, right? These are not high-rise towers that you're going to see. In some cases, there are some of which are a bit controversial. But I think more often what you're going to see, some of it is driven by, you don't really have a lot of the land that is conducive to it. A way to deal with some of the challenges on the construction cost side, if you can get the math to work, is to build, an 85-foot podium project. And I think we are going to see a pretty significant difference in 5 years, but it won't be as striking as it was for those of us who've been in San Francisco a long time when Rincon built the first high-rise residential towers anywhere in San Francisco, and what we've seen happen around Mission Bay and around the Trans Bay. I think it's going to be more subtle than a dramatic skyline. Really hit you between the eyes perception.
Yeah, I would agree with that. I think we're going to see more development for all the reasons we discussed. Rents are going to continue to march upwards. Demand is going to be there. So there will be capital and there will be developers moving projects forward, which is a good thing. And I think we're going to, over the next 2 years, see quite a bit of that. There aren't very many cranes in the skyline right now, but I do remember in 2016, 17, 18, when we did our last condo project, there were 28 tower cranes in the sky, and we had to reserve our tower crane for our Union House project 6 months in advance so that there would be a tower crane when we started. And I don't know whether we'll get to those kind of go-go days, but I suspect with rents continuing to march up, we will see more development. And I do think, like Michael was saying, I don't think we'll necessarily be seeing kind of the in-your-face super high rise, but we will see, more low rise, mid rise, and I think as well spread throughout the city. So we've seen a lot of concentration of development in the southeastern parts of the city, and we'll continue to see that, Pier 70 and the power plant site, et cetera. But I think what's exciting is with the new family zoning, we will start to see more development on the western side of the city. We're looking at our first project in West Portal now, which is a neighborhood that has seen quite a renaissance. There's a lot of new restaurants and bars and life there that's actually bringing people from other parts of the city to that area for the first time. And then you have people who have, grown up there and they want to raise their families there and want to be there. And so we think there's going to be ample opportunity in areas like that to see more development that we're excited about.
One more thing, and then we can kind of wrap this thing up here. Let's talk just really quickly about retail. You know, we've been focused so much. We touched on office a little bit. We've been focused on housing. Housing's obviously the biggest thing here. But retail, what are we seeing in key retail locations, Union Square, et cetera? You know, I know that at GSP right now, I'm working on a project financing a retail deal over there, and you know, everything looks good. But curious, you know, what's your guys' sense of that? How are retailers viewing leases? You know, give us your scoop.
Yeah, I mean, look, I do think we're on the edge of seeing a pretty significant uptick in retail in San Francisco and across the Bay Area. A lot of that is driven by the exact same economic factors that drive multifamily. We have a lot of high income
Disposable
earners
income. People want to
living
spend it
in the
locally.
city. I personally, we've looked at a lot of deals around Union Square. You have recently been able to, if you can buy at a really, again, historically low basis. And I think we are seeing a slow but steady march of some really high end retailers moving back into Union Square, as well as some of the bigger national brands. But there is still work to do, you know, and I think the mayor's office is focused on this. It is really hard to open a restaurant in San Francisco. I think it's hard to open a restaurant in California, but it's really hard to open one in San Francisco. It's one of the great dining cities in North America. And, you know, we do wrestle with the fact that in our larger multifamily projects, you know, look, the reality is you're doing you're not getting base rent, you're getting percentage rent, you're writing TIs. In our view, a good tenant is an amenity for the building. And so if we can recover our costs on that ground floor retail, which I understand is different than really thinking of a power center or a high street retail area like Union Square. I think all of it is picking up. I think, but as an asset class and in San Francisco, I think it's been lagging. And I think if you probably look at the last 30 years and the last 30 cycles, it's always been the case that it's kind of the one that's coming behind.
Good.
Yeah, I would add to that. Yeah, it's been great to finally see Union Square coming back with the likes of Chanel, Patek Philippe, Rolex, Nintendo, Zara, Max Mara. It's kind of a who's who list coming back, and I think showing confidence in Union Square again. Streets like Hayes Valley are booming again. Chestnut Street, I don't think ever, you know, went to sleep. I think it's, you know, even more vibrant now than it was before the pandemic. And through the pandemic, it was very vibrant, particularly because of the restaurants kind of spilling out and creating parklets where it felt more like Europe. And I think on the restaurant front, you know, 100 new restaurants plus have opened in San Francisco since 2023. So that's coming back in a very big way. Although, like Michael was saying, it's very expensive to open up a restaurant in San Francisco. And so when we're looking at what to do with our commercial space, the TIs are so cost prohibitive that we're often shying away from restaurants and looking at kind of lower cost to build retail concepts such as gyms, fitness concepts, Pilates. We just put a Pilates studio into Union House, where not only is it lower cost up front, but you get higher income on the back end. But it is great to see that it does feel like we've turned the corner and retail, restaurants, et cetera, are on their way back.
Yeah, no, I agree. And the TI problem is real. My son's been wanting to open a lemonade stand this summer. I don't know.
We've got a great retail space, Evan, in Potrero Hill.
Yeah. Well, guys, really appreciate your time. I know you guys are both very busy. I just find it very fascinating that, you know, you guys are such successful developers in such a difficult city to develop in, and started your firm at the same respective firms the same year. It's kind of interesting. And thank you for what you guys are
appreciate your
doing.
insights.
Yeah. It's very good.
It's funny. I think the last time I saw him, Eye panel with Senator Minor and Assemblywoman Buffy Wicks. And yeah, something I love about San Francisco's real estate community is because we all have gone through the same crucible and it's a tough one.
Yes.
We're quite congenial. We're very collaborative. I used to tell people, when someone else is succeeding, I feel good about it. I know what they went through. And every time I saw a crane in San Francisco, I thought an angel got his wings. I mean, and it's nice. It makes being in the real estate business in San Francisco really pleasant. And it's always good to see Mark. And we have they're, I guess, competitors, but we all feel like we're all kind of going in the same direction here, and there's more than enough to share.
Yeah. What's
Agree more. Yeah. It's not a zero-sum game in San Francisco, and we're all rooting for each other, helping each other. We need more housing. We need more good housing. And so we're thrilled to see Michael and all of his success at Quincy, and have been rooting for you all the way. And it's really helped, I think, lay the groundwork for everything that will come. So yeah, it's a great community. And yeah, and Evan and David, pleasure to be here with you. Thank you for giving Michael and I the opportunity to speak on your podcast. It's a pleasure.
We're glad you did. Thank you, guys. And again, we'll wrap it up here. And again, for all our guests, these are, of course, available at gspartners.com, and it's syndicated all over the place. You can subscribe on Spotify, on Apple Podcasts, YouTube, wherever. And of course, you can visit Michael and Mark's company websites. We'll put them in the description below here. Thank you, guys.